New season, brand new year. Real Sense Now. Thank you for being a real sensor and being a part of our show every single week. I'm really happy to do this show because we get to share a lot about what's going on in our real estate market, trends that are happening, what's happening with our economy, and really give you a sense of what's trending in real estate. Of course, if you want to catch us on this show, all you got to do is tune in every single Saturday from 11 to 12, or you can always catch us on YouTube and on any one of the podcast platforms that air our show. You can just simply go to Amazon and say, hey, Alexa, play Florida Man Radio. Especially if you're tuning in at 11 to 12, you're going to hear this beautiful voice. We're kickstarting this new year, like I said, with a brand new Real Sense Now season. And today we're going to be talking about something really interesting. We're reflecting back on what it was like being in the real estate market in 2022. And I think one can compare to buying or selling tickets to a Bad Bunny concert or even a Taylor Swift upcoming Eras Tour concert. You knew it was going to sell out. You knew you were likely to pay higher than ticket prices. And you knew that if the person that didn't go out and buy the ticket, you know that there was probably going to be 100 other people behind them that would be willing to be paying way more than ticket price value to go out and see one of these guys perform. Our real estate market was pretty much of the same. Just like the ticket holders weren't worried about the demand, the agents in both the real estate and the mortgage sectors didn't really need to bulletproof their real estate business at all. There was basically a buying frenzy. Buyers with a home to buy were like piranhas waiting for a chance to chomp at any morsel of an opportunity to just get in the market and taste the possibility of what it would be like to purchase a home. Many times they were often beat out by multiple offers and other buyers that were willing to pay way more than asking price just to be able to get into their home. Waive appraisal contingencies, waive inspection contingencies, waive every single contingency possible just to be able to get in. But of course, you could say that the 2022 real estate market was a wild and thrilling ride, a white-knuckled roller coaster ride like the newest, hottest addition in one of our amusement parks here in Central Florida. Another great year following 2020, 2021 with a lot of buyers going, am I ever going to get a chance to get in to this market and buy a home? Demand and home prices hit an all-time high, and cheap money allowed more homes for investors and home buyers to keep that market hotter and hotter, and home prices just kept going up and up and up. Hedge funds and institutional investors raised as much money as they could to come out and buy as many homes as possible that could have possibly gone towards home buyers that actually wanted it for primary use. But of course, what comes up must come down. And before mid-year, there was a screeching halt in our real estate market, an abrupt U-turn, if you may, in the opposite direction, of course, which was in response to higher mortgage interest rates. We saw the mortgage rates increase from 3% to, what is it now, 6.5% or something in the other, depending on how well you can qualify or how creative the loan is. You're pretty much paying that type of an interest rate for a mortgage right now. And of course, with so much fluctuation in different markets across the United States, we saw people relocating throughout COVID, people wanting to work from home, move to warmer places, maybe get a bigger home, get out of that little box in the sky that they lived in. And what we noticed was the cities where those moves happened as a result of COVID were many of the cities where prices were jacked up, and where a lot of the cities which remained near their peak, even when a lot of the other cities throughout the country started to dip. And investors alike were scouting the nationwide to figure out where they should park their money next. Where's that next investment going to be? Or should I just basically wait on the sidelines like a lot of buyers did to wait to see how the market would shake out? Because there was plenty at stake for those who purchased a home, let's call it in the middle of 2022, what I would like to call at the height of the market. Why? Because that was pretty much the last opportunity before interest rates started to go up and we started to see a shift in the market. For those who purchased a home at that height, it could possibly mean that depending on where you are in the country, your home is worth a lot less than what you had paid for it at that point in time. And for those who were priced out of purchasing a home over the last few years, the same price declines could also mean a brand new opportunity for you to finally get out there and snag a home. Why? Because there's more homes that are available for you to purchase. There's an increase in inventory of homes in the market. And then consequently, that last buyer, the one who actually was able to purchase in the last few years, where prices started to increase and remained high, those are the owners that were able to gain the greatest amount of equity in the home that they purchased, enjoying the market pricing increase over the last few years. And it was also the major reason why that equity that was built into these homes were the greatest differentiator from what a lot of people that were riding this wave, trying to analyze the market, understand the trend that differentiated the Great Recession in 2008 from what was occurring right now. Because for the first time, more and more homeowners had greater equity in their homes and were essentially using this cheap money to be able to go out and purchase another home, a larger home, a vacation home, whatever the case may be. According to George Ratu from Realtor.com, the senior economist and manager of economic research, says it is a who's who of cities that became popular during COVID-19, and these destinations for people who were fleeing hot and high-cost urban areas to move to these other areas where they were able to snag a home, essentially. And we're seeing that these markets now finally are coming back down to earth in terms of its price. The natural reaction to a sharp run-up in prices over the past couple of years is now meeting the new higher mortgage rates this year. And for those markets that have held up to their price increases, he says they are historically affordable location, mostly in the middle of the country. We noticed that may be the case, but we've experienced that Florida has been a hotbed for a lot of people that have been wanting to move here, especially cities like Orlando. Why? Great weather all year round. A city that's a lot more affordable than other parts of South Florida as well too. And what a lot of people are trying to figure out is what that dynamic is going to play during the spillover effect, where after the pandemic, after these hot markets have been infiltrated by people moving from other parts of the country and investors alike. And more importantly, the question that is on everybody's mind is, what is 2023 going to look like? How is it going to shape up? And is it going to be an encore of 2022? To help answer a lot of these questions, I have my guest, Mr. Gilbert Vargas. He's the founding member and CEO of my home mortgage company. And he's here to help answer a lot of the questions for us today. I think part of the interesting part of this dynamic and conversation that we're going to have is that you're going to get to see a bird's eye view, both from the mortgage side of this industry, as well as the real estate side of the industry from my perspective as well. So Gilbert, thank you for being a guest on my show, and thank you for joining us once again as well too.
Good morning. Thanks for having me.
You know, CEO Warren Buffett from Berkshire Hathaway once explained that one of the metrics that he watched for was for a reversal in the housing market is when you can start to see a reduction in housing starts, which would often mean a cooling in the housing market in which the supply outstrips the demand, which is basically one of the best ways to solve or to create more demand by reducing the number of homes that are newly built as well too. But we're seeing the opposite happen now. We're seeing more and more homes that are coming onto the market. There's a greater amount of inventory, and a lot of national home builders are either stopping, reducing, or trickling down very slowly more inventory for spec homes or just homes onto the market as they were in previous years. Is that something that you're seeing as well too in your side of the market as well?
Absolutely. Seems to be a lot of buyers that are coming into the market that finally realize that this is an opportunity to perhaps stop renting and take advantage of some of the incentives that are coming through, particularly from the builder community. we work with several builders, and so what we've seen is incentives have gone up across the board, and as well as commissions to agents have gone up. So we see a huge opportunity there. In regards to, buyers are looking at resale transactions. We want to make sure that that those people really understand the opportunity and how they have to navigate that. I would say that they should work with a real estate professional.
And it's interesting you say that, because although housing starts slowed to an annual pace of about 1.427 million last month as compared to 1.43 or 1.49 in the months previous to that in October and September, you're right. I myself am also noticing a greater demand of buyers wanting to enter this market in the beginning of 2023. I believe it could be because they've waited by the sidelines, rents are going up, and they're just getting fed up and are deciding, you know what, we do realize that the market is shifting, that there is a greater opportunity for sellers wanting to cooperate with buyers, that there are new home builders or national home builders that are offering incentives and also even reducing or discounting some of the prices of the homes, making it more affordable as compared to last year for a buyer to get into the market. Is that something that you're noticing as well too?
Absolutely. So, for example, with new home builders, what we've noticed is that they are part of the incentives that they are allocating to each transaction goes towards buy downs. And so what that does for the buyer is it reduces their monthly expenses and makes it easier for them to transition from renting and moving into home ownership at a lower monthly expense.
You know, we've also noticed a downtick in the mortgage rate, especially in this last week. Do you think that that is going to be an indicator for a lasting support in our current market? And what do you think would be some of the fundamental drivers for what we should expect in 2023?
That's a loaded question, my friend.
Let's break it down.
I will try to answer it as best as I can. So when we look at historical numbers in regards to mortgage rates, for example, last year, this time, we were in the threes. We went April 1st. There was some news came into the market where the government had placed in some additional adjustments to pricing in regards to investment properties as well as second homes. And so with that, along with Federal Reserve making increases on their short-term rates, we've seen the market really just take off.
That's, by the way, 7 out of 8 times they've increased the market rate.
Right. If they tell you they're going to do something, they're going to do it. Right. So typically the Federal Reserve works kind of like they try to make you think or make you I don't know. They speak in a way that perhaps I'm speaking right now, which is not necessarily not making a lot of sense. But at the end of the day, if they're telling you straight up that they're going to do something, they're going to do it.
So where do you think the rates will settle in, let's say in the middle of 2023 or more so towards the end of the year?
So the trend looks like rates are going to be adjusting a little bit lower. There's many factors that are going into that. And perhaps we may be looking at rates in the low 5s and perhaps even the high 4s.
Which, by the way, is pretty much the average prior to COVID for what the rates were in the decade prior to that as well too. So it's not an unreasonable number to be looking at as well too. And to your point, do you think that will be enough to get buyers, sellers, and investors off the sidelines when the rates go down to those numbers?
Well, you really have to look at the long-term picture here, right? So if you're a trader and if you're trading houses, perhaps mortgage rates should not necessarily be the driver of your decision-making process, right? But if you're a buyer that is going to sit in the property for the next 10 years, you really got to look at, okay, your overall expenses. And so are you going to stay renting? Are you going to move into homeownership? Or as an investor, are you going to just go ahead and take advantage of the incentives right now that perhaps some builders are offering and the pricing opportunities that you have with resale transactions to acquire property for investment purposes and perhaps look to refinance down the line?
I love it. And you know what? This is the one thing that I tell my buyers all the time. Unless you are a flipper, with the sole intention to add value, therefore increasing the current highest and best use of this property, and be able to drive the price up because you're expanding the property, you're doing whatever you need to do, real estate should always be considered as a longer hold, 5, 10 years, 15 years, whatever the case may be. And of course, if you want to connect with me or have a real estate question, please visit my website at realsensenow.com. You can catch me on all of my social media platforms. That's Facebook, Instagram, and LinkedIn by just typing in my name. That's Dawood Bedrosian, Dawood, last name Bedrosian, Bedrosian. Of course, call us live right now, right here. Feel free to call in or text 321-339-1055. And remember, real estate market, whether it goes up or down, it always trends upward over time. Stay tuned for my next guest, my next segment with Gilbert Vargas, where we're going to be tackling the economy, the mortgage market, and where the trend is going in 2023. Catch you after the break. We've been talking about the economy and what we think may be some of the trends that we should look out for in 2023. But it seems like every time we turn on the news, yet another major corporation is laying off thousands and thousands of employees, and it just never stops, making us all more afraid of where this economy is going, whether or not we are in a recession or about to experience one. Amazon just laid off 1 to 2% of its workforce in January 23, DirecTV 5 to 6%, Salesforce 10%, and the list goes on. DoorDash 6% of its workforce in November, Meta 13% of its labor force in November. You know what? This is too depressing. I don't even want to talk about this anymore. But what's interesting regarding the mortgage and real estate market is that Wells Fargo announced some big news which really shook up the real estate world, which is they were really changing the way that they do business in order to protect themselves against the risk of mortgages and form what appears to be potential trouble on the horizon when it comes to the home mortgage for home mortgage companies. Or, for example, anybody that's dependent on a home sale to be a major source of income, such as real estate agents. Wells Fargo literally laid off thousands of employees in their home mortgage division in 2022 because they're scrambling to try and survive in this shift that's occurring or in this downturn that's occurring in this housing market as well too. And if you are a listener to our show and you know what we're talking about, we're always trying to give you a sense of what's happening over here. Wells Fargo has been one of the largest players in the home mortgage space, and they've announced their cutbacks in their mortgage division in April 2022. And they had about 10 rounds of layoffs as of September 2022 as well too, in October 2022. And it's basically there because what they were trying to do is they're trying to change the way in which their business operated. And one of the things that they discussed was many of the people that are depending on home sales or income from that are wondering, how long is this going to take? When is the shift in this mortgage space going to occur? When are mortgage rates going to balance out? And what companies like Wells Fargo and a lot of major other industry leaders are announcing with regards to a lot of these layoffs here is that they are shifting the way in which they are tackling that part of the business. And what they've basically stated is that they're looking to reduce the correspondent lending, to reduce the mortgage servicing of the portfolio of mortgages that they have in an effort to slim down their mortgage business. Seems a little bit surprising because a lot of us look at banks and think that's a major source of their income. That's what banks do. They provide mortgages to people looking to purchase a home. And my guest in our break, Mr. Gilbert Vargas, who's the CEO of my home mortgage company, actually shared a very different insight on that. Gilbert, can you recap on what we were sharing on the break, and why are you noticing that a lot of these big giants are veering away from what would typically be typical business for them, providing mortgages for people looking to purchase a home?
Wells Fargo, an example, right? So Wells Fargo, it was at one time the nation's largest mortgage lender. You would think that that's their core business. At the end of the day, just like Wells Fargo and other banks, mortgage is just a line of business that is just, it's a high risk line of business. And so banks make their money primarily really on the institutional side. And so general public, we are just not necessarily where their bread is buttered. They have to service us because there's certain regulations that require them to serve the community, which is one of the reasons why they've assigned about $100 million to grow their community, or to basically invest into their Community Reinvestment Act obligations.
Which will basically advance the racial equity and home ownership that they're looking to do, so that they can continue to specialize in providing these mortgages for minority groups as well too, which is a really good endeavor to do, in spite of what they're doing on the opposite side of reducing the corresponding lending, which is nice to see as well.
Right. I mean, our industry, there's always cycles. Personally, I've been through 3 cycles in my 30-year plus career. And I can tell you that this is an opportunity for people like, for example, us. We're actually hiring. So any Wells Fargo employee that is displaced, please feel free to reach out to us.
I love that shameless plug over there.
Absolutely. We're looking to grow. And just like us, many mortgage companies are looking to grow their business, because at the end of the day, this really poses an opportunity. The way I see this, in my experience, is that it opens up the door, because most of these big players, they're too late in turning around. Just imagine a huge ship making a U-turn, and so by the time they turn around, the tide might have turned already. So they may be a little late in regards to this. We know of many mortgage companies that were actually laying off people in 2021 because they foresee they were able to take a look forward and see that rates were going to be moving up, which meant that refis were going to go away, which meant that people that depended on the refi business were also going to go away with that. So they took a position where they started laying people off in their operations that were servicing primarily refi opportunities. We focus on purchase transactions, and so what I would say is that look for more of the other banks to do the same.
It's funny you say that, because the gist of this conversation, or the intended intention of this conversation, was to be able to provide the listeners, provide the viewers with a bird's eye view, both from a mortgage perspective as well as a real estate perspective. As I said, I've noticed since the kickstart of this year that more and more buyers are entering the market now. Those who are waiting on the sidelines are decided to either A, purchase a home, sellers are deciding to sell a home, and more importantly, investors are re-entering the market as well too. I was reading an article that refinances have also seen an uptick in recent times, as with mortgage rates decreased in this past week as well too. Mm-hmm. And more importantly, I'm also noticing that a lot of the bigger banks that I would normally refer to for certain investor loans or even foreign national loans are stopping those practices as well and narrowing down their focus to purchasing a primary residence or secondary residence. And I'm beginning to notice that there's even more creative programs with companies like yourself than a lot of the big boys that don't offer a lot of the same programs as well too. Maybe they're too big in size, maybe it's too difficult, or they're not agile enough to get on their toes and stick and move. I'm not quite sure. What are some of the trends that you have noticed as well in terms of how you have offered more creative products in our current market, assuming that there could be a recession looming ahead?
The way we approach the market is that there is always an opportunity. There's always a way to help someone, right? So when you look at banks, We also obviously manage risk, but our risk is different than their risk, and so they have to take care of certain things. We handle business in a different way. Our primary business is the mortgage industry, right? So we have to be alert, and we have to be flexible to change with the tides and be able to navigate the water. So what we've noticed is that we've noticed a lot of the buyers that are coming into the market are the first-time home buyers, that people that are paying $2,500, $3,000 a month for in rent are actually understanding and realizing that, guess what, your rent is not going to go down. It's actually going to go up. And
it doesn't really do anything for you. You're not building any equity. You're not creating any wealth for your family. You're essentially just giving away that money in order to have shelter for you to stay in. Absolutely.
And so, I mean, if you're someone that perhaps doesn't necessarily need to own a property because you're moving from city to city and you just have to work there for a certain amount of time, but that's not the majority of the people, right? So majority of people are looking to live somewhere for a long time. So the best thing that I would say, and that what we've seen, is that we see a lot of new home buyers coming through and getting away from the renting market.
But then, the question that's on a lot of people's mind is, if interest rates are in the sixes and we have a recession coming ahead, or we're in a recession, who knows? Who knows how to really define it these days? Why would anybody want to buy a house? And why would now be a good time to buy a house right now? Because it's 6.5%, I'm not buying a house. But guess what? We went to lunch the other day, and you shared some really interesting information about a lot of new programs that are out there that a lot of people may not even know about or have even heard about. Can you please share with me what some of these new creative ways of financing that are available for people not to have to go out and pay these astronomical interest rates?
So I guess, I'm very old, because astronomical to me is not 6%. My first mortgage was at 8% back in the day when I first bought my first place. But I know that the psyche of it is that mortgage rates at 6.5 are high generally, right? So, but when we look back at 2005 and 2004, mortgage rates were at about 6%, and the market was red hot, right? We have a different situation now. But in regards to what we're doing to navigate this is that we have programs like buy downs. And so, for example, if you are working with a real estate professional and you're working with a professional mortgage expert, that person should be able to look at your situation as an individual and make a recommendation. You should not go to someone who just doesn't know. Please don't go to your cousin who is just started in the mortgage business, or this is a market,
real estate industry,
right?
For that matter.
For that matter, the real estate market, because this is this situation in the market. You need to have an expert next to you, and so we walk customers through the process of home buying, whether they're foreign nationals or the first-time home buyers, or investors, and so on. And so, for example, on a buy down, right? So let's say that you're self-employed. And let's just say that you don't have necessarily all the finances together. We have a program that with 12 months bank statements, we can actually offer you a mortgage with a buy down option. And
what is a buy down option? Break it down for me, please.
Right. So for example, let's say that your rate is at 6.5, right? So with the buy down option, it depends on how many years, but the average goes out to 3 years. So for example, you have a situation where your rate is at 6.5, right? So the first 12 months, your rate is at 3.5. Second year around, your rate is 2% less than the actual note. The third year is 1% less than the note. And then the fourth year, it adjusts to what the note originally was for, which was 6.5.
So let's assume 3.5 in your first year, 4.5 in your second year. Let's say maybe 5.5 in your third year, and then adjust up to 6.5 if it's 6.5 to start off with?
Right. So so the note is for 6.5.
Okay. Your
payments are based on 3.5% for the first 12 months, 4.5% for the following 12 months, and then 5.5% for the next round. But what that type of program does is that it allows the person to, first of all, move from renting and have a comfortable payment, and also get their finances in order to be able to refinance when rates come down, because it is very likely that by the end of this year, rates are going to be lower. And so that opens up the door for you to be able to refinance.
Ladies and gentlemen, that is a public service announcement. To have information like this will empower you to make better decisions when you're planning your future in order to make the purchases that you need in real estate to be able to secure a new property and investment property and to be able to create wealth for you and your family. It is for this exact reason why I am so grateful to have the guests that I have. You're not going anywhere. You better stay here after the break because I need to learn more about the options of these types of programs that are out there and why a looming recession could actually be a good time for you to go out and purchase a home. Stay tuned after the break. This is your host, Gilbert Vargas. You're listening to myself and my guest, Mr. Gilbert Vargas. We'll catch you after the break. Oh boy, let me tell you. I got flashbacks of the horror of sitting in calculus or algebra or finite. My guest, Gilbert Vargas, the CEO and founder of My Home Mortgage Company, has been basically teaching me about all of these new programs that really allow for buyers that are looking to get into the market to not get that sticker shock of a 6%, 6.5% interest mortgage rate for a 30-year fix, and really kind of find some new creative ways to be able to get into a property with as little as 3.5%, 4%, whatever the case may be. Listen, it was way too much for me to swallow in one sitting, so I'm going to get the expert to explain it to you. All right, here we go. Calculus 101. 3, 1, 2, 1, 1, 1, 2, 1. What are these buy downs? Tell me about some of these programs, and let's talk about the pros and cons of why you should or shouldn't get into them.
First of all, the buy downs are available for FHA, VA, conventional, jumbo. We do jumbo.
Hold on a second. Wait. So you're telling me with as little as 3.5% as a down payment, I can still do this buy down program?
If you're working with a professional like Dawood.
No, like you, because you're going to help my clients buy a house finally, which they were afraid to in a market that has a 6.5% interest rate. Go on.
If you're working with a professional like Dawood that brings you to me.
Okay, here we go.
Then you'll be able to understand how simple this could be, right? Okay. So it's not that difficult. So for example, on a FHA mortgage, we can qualify you with as little as a 580 credit score.
Correct.
Right? As long as you're employed, you have a good credit history, and you're able to repay the loan, you may be able to participate in this program, right? So,
and we're talking about how much of a down payment?
So just 3.5%. So for example, if you have, if you're buying a property, and your realtor, your agent is able to negotiate a seller credit, a portion of that seller credit goes towards buying down the rate.
Got it.
So you have 36 months worth of a lower payment.
Got it.
You're not paying for it. The seller is paying for it. So instead of reducing the price too much, perhaps they'll reduce the price, but then there's another incentive that goes behind that, and that could be used to buy down the rate.
Okay, let's talk about the rate buy downs and the different programs that are out there. And I want to touch on it because everybody is going to be different. It's going to be on a case-by-case basis. But just give me a high-level overview of some of the buy-down programs that are available and why people should take advantage of them today.
High-level overview as far as
3, 2, 1, 2, 1, 1, 1. What are they? How do they work?
Well, again, so these particular programs are available, FHA, VA, conventional, jumbo, and non-qualified mortgages, which encompasses, for example, bank statement loans.
Got it.
So if someone that doesn't have their taxes done, for example, they're a business owner, we may be able to do a loan for them with just a 12 months bank statements, a P&L, 1099, and so on. And so it covers the entire gamut, at least through our firm. And so the opportunity is for someone to get out of renting or for someone that is relocating to be able to acquire a property without necessarily having to pay the higher rate up front. And if your question is why should they do it, they should do it because if you still need a house, right? You still need a place to live. You still need to live somewhere. So if you're renting, you should be taking advantage of this program because regardless, at the end of the day, even if there's a recession, you still need a roof, right?
But why wouldn't everybody want to jump into this program rather than go into a fixed interest rate for 30 years?
Well, sometimes it depends. For example, investors are not able to participate.
Okay.
Right. So, if you're investing into a property, this is not a program that you're going to be able to take advantage of. And, interest rate at the end of the day, if you're investing to flip properties, rates should not necessarily be at the top of your list of things that are important.
Okay. So basically, to break this down, a buy down program allows the buyer to basically enter this mortgage or the life of the mortgage at a discounted interest rate for the first few years. Let's call it 3 years for the 3-2-1 program, 2 years for the 2-1 program.
Right.
So essentially, if we were to use an example of a 6.5% interest rate, we're talking about possibly a 3.5% interest in the first year, 4.5% interest in the second year, and let's call it a 5.5% in the third year. Is that correct?
Correct.
And then do you have to commit to the life of the loan? Meaning, can you break out of that without a penalty?
Very good question. Very good question, Dawood. So no, this particular program, there's no prepayment penalties. And so what we've advised most of our customers that are a little bit worried about, let's say, the rate going to 6.5%, is that stay in touch with us. We will also stay in touch with you. We'll monitor rates. And so, for example, if your goal is to lock your rate at 5%, if there's an opportunity where rates come down or to 5% or at least very close to it, our office will be in touch with you to help you refinance. We also offer a program tied to that that allows for you to refinance your house for as little as $350. Okay, so there is usually closing cost with your transaction, but there is an agreement, a national agreement that most lenders have, where you're able to refinance for just $350.
I'm really happy that you were able to share this information. Before I even ask you the next question or get into the next topic, this is so useful for a lot of my buyers that are specifically residents of the United States or Americans that could easily take advantage of this program and not at least worry about having to pay a hefty interest rate in this market right now. Before we go any further, somebody has a question or if somebody wants to reach out to you, what's the best way to reach out to you and your company?
The best way to reach out to us is just by visiting our website, 𝐓HMCFL.com, 𝐓HMCFL.com.
And they can call you, they can fill out an application right there on the website as well, too?
Absolutely. Our phone number is detailed on the website, which is 407-789-0779. And they can also communicate with us via our website.
I love this because what you actually done is really created a brand new way to look at 2023 and the opportunity to get into the home. For those buyers that have been sitting there on the sidelines, worried about higher interest rates and payments that would have, cost them hundreds and hundreds of dollars more in a mortgage payment than what they would have with last year's mortgage interest rates, now have a renewed opportunity to be able to re-enter the market and consider a newer home, possibly even a bigger home, with the potential of refinancing it on the back end. It brings us to this conversation that we've touched on several occasions throughout our conversation today, which is why buying a house during a recession or higher interest rates could actually be a good time for you to do that. And you've touched on a couple of things that really kind of came to my attention. I've jotted them down as well too. And it's something that I want to share. Many home sellers now face the competition of more homes on the market. There's a greater number of homes that are in inventory, allowing buyers a greater potential to pick a better home by having more time to go out, look at more homes, and find the ones that are available to them. You've also touched on the fact that interest rates can be bought down, which is another great incentive, meaning less competition and more choices for buyers. And this is the one thing that I really like to re-stress over and over again. I think one of the biggest fears for a lot of people is, how do I get into this market when the interest rate is high or keeps going up. And what the last piece of advice that I want to give you guys is here. In this market, the most important thing for you to do is to get your finances in order. Go out and reach Gilbert Vargas and his company. Tell us again how we can get a hold of you as well, too.
Easiest way to get a hold of us is visiting our website, mhmcfl.com.
And the best way to get a hold of me is by giving me a call right here on the radio show, 321-339-1055, reaching me on my website, which is realsensenow.com, or better yet, just sending me a DM on any one of my social media platforms, Instagram, LinkedIn, Facebook, by typing in my name, Dawood Bedrosian, and tuning in every week to find out how we can work with you to help you on your journey to build wealth through real estate. Catch you next week, Saturday, 11 to 12, right here on Real Sense Now.